You may have seen that recently, once again, the financial news is dwelling on the fact that, the yield curve has inverted again. Now, this is seen as being a possible warning sign of an incoming recession, which is exactly why the financial news, with their negativity bias and doom and gloom, choose to latch onto this. But what does all of this mean, and why are people in the media panicking about it? Should we be panicking about it? Let's find out. I guess the best place to start is by quickly explaining what a yield actually is, for those of you that don't know. So the Treasury yield is basically the return that an investor will receive on the US government bonds that they own. So if you were to buy a US government bond, in really basic terms, without getting too technical about it, you're going to receive an interest rate that the government's going to pay you to lend them that money. So there are a wide range of maturities that you can choose from, and this term maturity basically means the amount of time until the original amount of money is paid back by the bond issuer. So for example, you might only want a 1-year maturity, or if you're in it for the long haul, you might want a 30-year maturity. Then the payments that you receive are known as coupons, and the rate of return that you get on your capital from these coupon payments is represented by the yield, which will vary depending on the different maturity dates. Typically, the longer the maturity date, the higher the yield will be due to time-associated risks. For example, the risk that higher inflation reduces the value of payments, or that interest rates go up. So this means that when they're plotted onto a chart like this, because of the different yields depending on the maturities, you have what's known as a yield curve. Now, the price of a bond and the yield of that bond have an inverse relationship. This means if the price goes up, the yield will fall, and vice versa. So if there's demand for bonds, the prices will increase, the same as any other asset, and this will mean that the yields will fall. Now, if you want to know more about yields and the yield curve, check out our previous video on it. We'll link up here for you. Okay, so what's happening at the moment is that the 10-year bond yield, which is known as the benchmark rate, took a bit of a dive, and the 2-year yield increased. So this closed the gap between the 2-year and the 10-year, and they did actually invert last week, and they still remain really close at the time of recording this. So yeah, big deal. Why does this even matter? Well, for some analysts, traders, investors, and so on, the crossing of yield curves is signaling the rapture. The end is nigh. We all need to prepare for doomsday in the financial world. I mean, after all, historically, in most cases when yield curves inverted, a recession has followed. In the past 50 years, every US recession has been preceded by an inversion of the yield curve. In fact, according to a paper that was released by the Federal Reserve Bank of San Francisco back in 2008, forecasters placed too little weight on inverted yield curves when projecting declines in the economy. They even found that yield curves are better at predicting recessions than professional forecasters. Shock horror. So let's talk a bit about what all of this actually means. The difference between the yields can signal how confident investors are that the economy is likely to continue to grow. So if the yield on a 30-year bond widens against the 10-year, then that's a sign that investors expect the economy to continue growing, as there may be more appetite for riskier investments with higher returns. However, when this reverses and the spread between the yields close, this could be a sign that investors are less convinced that growth is going to continue. They might think that inflation is going to drop and real rates are going to fall, both of which tend to happen during recessions. So this means investors would rather hold the less risky, longer dated bonds. So the primary yields to focus on are those between the 2-year and the benchmark 10-year, which just turned negative a few days ago. So I guess that must be the end of the world as we know it then, right? Well, maybe not just yet. Although a yield inversion usually precedes a recession, it's not actually a very good indicator for the timing of a recession. For example, the yield curve inverted in 2006, and that was 2 years before the 2008 financial crisis. So it can vary from anything from 2 months all the way up to 2 years and maybe beyond. And using yield curves as a predictor of recessions definitely has its critics as well, such as Ben Bernanke, the former chairman of the Federal Reserve. However, rather ironically, when he became the Fed chairman back in 2006 and the yield curve then inverted, he told everyone not to worry about it. He said, I would not interpret the currently very flat yield curve as indicating a significant economic slowdown to come, and we know what happened shortly after that. However, he did say before the pandemic that it's possible the yield curve has lost its predictive power due to the market distortions caused by central banks through regulatory changes and quantitative easing, and this could still be the case. I mean, after all, back in March 2020, the Fed undertook the biggest QE program in history, which saw $120 billion in bond buying every month. Now, the Fed recently stopped this in the face of higher inflation, and they're expected to raise rates now at the fastest pace in decades, which has therefore resulted in Treasury prices being pushed lower and yields therefore being pushed higher. The current Federal Reserve Chair, Jerome Powell, hasn't been that worried about the tightening gap between yields so far. In fact, Powell has cited the steep curve in short-term yields as being a clear sign that the Fed has room to raise rates without harming the economy. But these comments have received some pushback, for example Citi, who have said that Powell is ignoring forward curves that are deeply inverted, and therefore they've increased their probability of a recession in the next 12 months to 20%, up from a probability of 9% that they had back in February. At least for now, the data isn't really showing a recession yet. Last year, the US economy grew at the fastest pace since 1984. The labour market is also really strong with good reported numbers over the past few months. But obviously, with inflation running very high and disruptions from the Ukraine war, there's plenty to be cautious about. Now, if you haven't already seen it, do check out our video on the yield curve, which you can see on screen here, or check out the playlist that's also on screen where we explain all the economic data releases that you see in the monthly calendar that will help you make sense of what's going on in the world. Thanks for watching. Take care. I'll see you in the next one.